Portfolio Builder members, today is Friday, the market just closed. I've decided to start doing a detailed analysis of all the open trades so you can see exactly how we're generating the profits when we're up, when we're down. So you won't get to see the trade alerts as they come out if you're expired or you're not subscribed to one of the different programs. But you will get to see how all three programs are performing at the close each day. So the first trade we're going to analyze was actually just put on earlier today. So this came out around noon Eastern. It was to sell to open the June 17, 2019 289 call option. And you'll note the last trading price, which is, let me zoom in a little bit more. So to analyze the profit loss, we have to really compare a few things. One, the change in price of the underlying asset. So in this case, it's the SPY ETF. So we'll look at the last traded price when we entered the trade, 289.05. Sell to open, that means we're short the call option. That means we get a credit of 94 cents. Okay, and we make most of the money the closer we get to that expiration in this trade. So to see a profit right now is nice, but not really expected until we get to June 17th. Now, if we look at the put option, this is the long put option. We paid a debit for this, so we'll get a credit when we sell it. And this started off at 41 cents. So now we need to see where the current prices are. So at the close of the day, we can see the following changes. And I summarized it for you right here. The SPY went up 46 cents. The short call option lost 10 cents. And the long put lost 18 cents. That's a net gain of 18 cents. The maximum profit we can generate if the SPY goes higher is 53 cents. If the SPY goes down, we can make a lot more. It's very hard to actually calculate that, but we really have a unlimited potential profit on that put option. Then if you kind of look at this in the future, if you were to do this 3 times a week, even if we just sold it right now for 18 cents per share or $18 a contract, that would be $2,808 a year of income, or a 10% annualized total return. If we get the potential profit, if the SPY goes higher, it's a lot more. It's $8,268 per 100 shares of the SPY we own, or a 28% annualized return. And if the market goes lower, again, it's a lot harder to calculate, but we'll be doing these updates daily so you can see what our open P&L is on all of our open trades in each program. Okay, the Diamond program traded on Tuesday, a Apple position. This one was more protective to the downside. In other words, we took more of the potential profit if Apple travels higher or flat and invested it into a put option. So this will really create a large profit when we start to see some volatility in the market. And if not, it still won't lose. It's just positioned to be a little more aggressive. So once again, if you want to pause the video or go to the email and look at these screenshots, you can. You can check my math. I've summarized it for you. This is the closing price. Again, this is our Diamond level membership. This only goes out to people who have a paid basic membership. You get a 30-day free trial in the Diamond class. That goes out Tuesday at noon. Or if you've actually purchased the Diamond Club, then of course you always get the Diamond Club. If you're just on a free trial, you won't see these trade alerts at all. You're just going to see the reviews in the evenings. So if we summarize this, Apple fell $1.91. The short call option gained in value $2.17, and our long put option hasn't yet kicked into gear. Again, these put options, they just lose until all of a sudden they grow exponentially if the underlying asset falls quickly and far enough. Put options down 13 cents. Right now, the current net profit on that's 13 cents, which is not much. That's 2.5% annualized return, $676 a year income. What I want you to remember on this trade is I showed you how to get a big free bet on Apple going down as the trade war escalates. That's when everybody's going to be thanking me on this trade Of course, if you don't invest in the put option, you're sitting on a nice profit right now because you didn't invest $1 of your potential profit on the put option. Now, if I'm wrong and Apple flies higher, we can still make about 10% annualized and $43 a contract on this trade. So either way, we're doing very well, but we have a lot of downside protection. There is that little band between where we are short the call and long the put, where we're a little bit weak. But again, the market on Apple has gone down $1.91 and we're up 13 cents. And we have a lot more protection underneath us. So that's really good. And it's hard to beat these kind of returns with this amount of safety. So this trade we will cover on Tuesday and continue a very similar setup. So if you don't want to miss out on that trade, you better upgrade your free trial so that you are in with the Diamond Group trade alert coming up this Tuesday at noon Eastern. Okay, now we're looking at our whale program. This is for larger investors who have enough capital to buy either 100 shares of Amazon or 100 shares of Google. Same setup, we're taking some profit from a in-the-money covered call and taking that risk-free credit. It's not completely risk-free, but because it's an in-the-money covered call, we have some immediate downside protection. And then we're buying that long put option, so we have additional protection to the downside. So here's the trade we put on just yesterday. Now again, you got to remember, when you're selling call options, you're in the game of letting the time premium evaporate. And as that time premium evaporates, that's money in your pocket. And that's how we really make money from these trades. So we just put this on Thursday at noon Eastern. So it's just barely had a little bit of a time to start appreciating and create the profits. Let's look at the summary. Again, if you want to go to the email or pause the videos, I'll give you a good, here's the closing prices today. Here's the entry prices. Let's just look at the summary I wrote. This one is net $1.53. So Amazon lost $1.69 in value, but our short call option gained $4.95. The long put currently is down $1.73. We need Amazon to fall a little bit harder and a little bit faster for that put option to do its real work. And so that's the goal while we get ready to anticipate tariffs rising and more volatility in the market. Now, of course, if we're wrong, it's okay. The potential profit if Google goes up a lot and we're assigned on the call option, which could happen, is a $10.36 profit, even if we lost everything on the put. That is a huge potential return in this setup. That's why I really like it. If we're wrong and we were able to do this exact setup 52 times a year, that's 28% annualized return. Now, if we go lower, there's even a higher potential return, but again, we do have a weak spot. We'll lose a lot less than everybody else out there if Google goes down, anyone who's long anyways. But there is a weak spot in this trade and all of these trades, which is right around where we write the short call and before we get to the level of the long put. Now we're going to, again, reduce losses dramatically compared to anyone else who's holding stock. We're going to be taking profits on the covered call, moving that strike lower. So we're going to do everything possible to never, ever, ever lose a penny, but there's always some vulnerability in any kind of trade you're going to get into. The Google trade is currently down 39 cents. Google lost $5 in value and 39 cents. And we only lost 39 cents versus 5.39. So we reduced the losses in Google with this current setup by 93%. Anyone else who owns Google lost 93% more money than we did. So that's nice, but again, we're waiting for the time premium to evaporate and make the short call option gain more value. And if Google does have a little more of a sell-off, that long put kicks into action. This setup, if Google does not fall and rises significantly and we're assigned, we lose all the value on the put option, we can earn $4.91 a share or a annualized return on this trade of 25%. If we go lower enough, Again, it's hard to predict exactly where the prices will go because it's a lot to do with how quickly Google's falling is directly related to how much that long put will go up in value. But we're set up to do very well. So that is a review of our open trades. And I hope everybody has a great week. And I do have a little bit of news and other content to share with you. And really quickly, before we do hop into the news, 505-322-7515. That's Dean's phone number if you do want to save. The basic membership is rising to $2,000 a year. So if you want to save $1,100, your chance to do that is about to end. Call 505-322-7515. And when you upgrade, you're going to get a few benefits. Number one, you're not going to ever miss a trade alert in the basic program. Number two, you're going to get a 30-day free trial to our Tuesday trade and our Thursday trade, where we're trading Apple, Amazon, and Google. And you're going to be added to the paid member only webinar on Wednesday instead of our freebie webinars on Thursdays. So don't forget, we do have a webinar coming up next week. If you're a paid member, it's on Wednesday at 1 Eastern. You'll get an email from Zoom with the links and all that good stuff. And then on Thursday, if you're one of our free members, that's when you'll be invited into that webinar. I'd like to start off with some content from Jeffrey Gundlach's recent webcast. Unfortunately, I wasn't able to view it. Usually I like to watch these live. His net worth is something like $2 billion. I'm not quite sure what DoubleLine manages. It's up there in the, tens, if not hundreds of billions of dollars. They're known for doing mostly bond market related trades. But he is always making forecasts on the stock market, gold, oil, all sorts of stuff. So this is just a summary that was from Zero Hedge of someone else's analysis. And it was well done, and that's how I first started getting in on that. He's watching Deutsche Bank, looking for it to break to that 6th level as a sign that the European banking system is weak. And then looking at how weak the German bond is at a negative rate. Looking at the euro export orders and PMIs, and everything's pointing straight down right now. Although it did start to kind of flatline for a little bit there recently. So he likes to look at the Korean Stock Exchange as a leading indicator, and believes that its technical setup is a leg lower. Then he segues into the U.S.-China trade war. China is now equal to the U.S. in terms of total merchandise. It is getting complicated, especially as we are now starting to see the effect of tariff wars, warning that people are underestimating the length and frictions of tariff wars. Here's a look at global merchandise trade percentage of the world. And so this is what the U.S. is so worried about. China's growing. Even though their growth is slowing down dramatically, they've clearly leapfrogged up to a very important number 2 spot at the table. And in terms of STEM graduates, he titled this webcast YouTube University. And I think what he's trying to point out here is that the people around India and China can use free things like YouTube to start to learn. And now these huge populations are pumping out these very valuable employees into the world that are going to be pioneering the way in science, technology, engineering, and math. And so that's very scary because the United States is way far behind on these STEM graduates. And he believes a recession has over 50% odds of starting in the next year, especially in the next 6 months, and that there's something like 65% odds by next year. He's looking at the U.S. Conference Board of Leading Economic Indicators, pointing down, not quite in negative territory yet, so in this chart, he's pointing out how long this economic expansion has lasted, but how little the real GDP growth is. So you can see it's only at 2.2%, compared to other economic expansions where they had anywhere from 3.5 to 7% GDP growth. And so his little story he likes to tell is, two buddies chatting. One guy's maxed out a credit card, has a car loan, mortgage, paying a ton of interest, always broke. The other guy has a bunch of cheap stuff, bought his house, and he's got $1 million saved. What's really the economic situation we want for America? And of course, what we have is the former one where it's based on a bunch of debt. U.S. Conference Board consumer expectations is looking very nasty and has been a very good leading indicator for a recession. Here he's joking about what on earth will the Fed do to start reversing their dots to make up for the big crash in yields that the bond market's priced in. Here's that 40 to 45% chance of a recession in the next 6 months and 65% in the next year. A lot of this definitely has to do with the timing of the trade war escalating, of course. Reminds us that the last few crashes were as the Fed was easing rates in 2000 and 2008. So they react to the crash. They don't necessarily stop the crash. Doesn't expect much next week from the Fed. So this Wednesday, I believe, is the next Fed meeting. Everyone's expecting them to basically warn that they will lower the rates next month and say as little as possible and get off the stage. Because remember, just December, they're supposed to keep raising the rates. This is a really cool chart. The point of this is to look at Japan peaked and then went flat and kind of nowhere for the last, 3 decades. Then we had, and that's in the purple. In the next peak is the Europe market peaking in green. And you can see it's gone nowhere ever since then. And he's just looking at these major economies. Emerging markets peaked in the 2008 crash and have gone nowhere since then, just flat. And now he's questioning, will this be the big peak for the U.S. and to go into a long-term cycle where it won't be able to climb much up in value. And so this is the same thing that Ray Dalio has been talking about forever, that there's little cycles and there's big cycles, and we're at the end of a big cycle. So the 2008 recession, the 2000 recession were tiny little blips in the terms of what could be a much longer recessionary regime. So if that's the case, then our strategy is going to do extremely well. Okay, this is the CBO's projection of percentage of GDP that will go to interest, and it's going to start climbing rapidly if we don't really grow our GDP faster. So far the GDP's been growing well, and that's what's been keeping all of the markets alive and having animal spirits. And my just guess, and it's not it's just a wild guess, is that we're going to see a stock crash from rising tariffs, lower the Fed rate. China has to finally come to a deal because they're having so much trouble, and then get a big boom in stocks. So that's something I think seems likely at this point. Here's the entitlements and mandatory spending, up to $2.5 trillion. So America has some debt problems. It just can't afford all of this. And so some of the big predictions I've been reading about are that the Fed will have to start paying our interest and buying our own debt. He likes to use the copper and gold ratio to predict the moves in the treasury market. And so you can see those are right on line and pointing lower right now, aiming at potentially lower yields. Now let's look at this. In 2016, when the TLT hit something like 144, we had to drop to 1.5 Druckenmiller's out there saying we're going to zero. So imagine what the TLT would go to if something like that happened. So that's something we'll be continuing to play in the Whale Club. And he says if the Fed were not manipulating bonds, the 10-year would go to 6% by 2021. On rates, the Fed is strongly signaling they're open to the idea of manipulating rates down. On rate cuts, July rate cut is a pretty good possibility. And a cut by September is basically a lock. The start of a rate cut cycle would be the Fed capitulating to the bond market, not Trump. On Joe Biden, we won't learn any new information on Jurassic Joe. He's run for president for 32 years, and he doesn't think he will be the main Democratic nominee. And he's long gold, but he's interested in Bitcoin. And again, this all ties into the trade war. Strong retail sales may be something that holds back the Fed from making any moves. I don't think they'll raise rates right now, but if they were to simply not lower rates, this would really upset the bond market and could quickly create an unwind in that TLT that's been going straight up. So our whale program currently has a tiny bet, a leveraged, a long call option on the TLT, or rather put option. But most likely I'll be playing it both directions. So look out in the whale program for 2 trades. We're going to be having a long call on the TLT and a long call on GLD, playing what would potentially happen if the trade war escalates. So those are some big bets that could generate very large returns, but they're going to be used with tiny, we're talking 0.25% of our portfolio in these sort of trades. And so non-retailers up 11% year over year. We're talking about companies like Amazon doing really well. And so this was a little concerning when we had that big drip down, but back to nice growth in the retail sector, which makes sense, right? If credit's cheap, of course, people should be spending money. So that would be really bad. JP Morgan, we are revising our forecast for 2Q real GDP growth up from 1 to 1.75. So that's a big jump. And again, we started off at like 3.2. Then to hear him come out with 1 was kind of alarming because everybody from the White House is still predicting 3, even with the trade war. And so here's the S&P 500 continuing to climb. And that's thanks to global money supply continuing to increase. China's dumping money into their system. The rich are flooding out of their country to try to buy anything except for their local currency because they're devaluing. That's why we've seen a lot of money flooding into treasuries, gold, Bitcoin, stock market, American stock market. This could become a big deal right now. U.S. is saying they're going to stay out of the way, but China is trying to control the governments in all the countries surrounding it, all the little Asian countries. So Taiwan, Hong Kong are not having it. They're very upset. Kyle Bass's big trade is that he thinks Hong Kong will lose control of their peg. So it hasn't happened in some 10, 20, 30 years. And he's expecting that it could soon. And so they are running out of cash that they've stockpiled to do that, and would have to start selling off some assets in order to continue to protect that peg. Meanwhile, U.S. continues to signal that Xi better meet up with Trump at the G20, otherwise there will be consequences. Michael Harnett from Bank of America has an interesting flow chart, really cool. I like it. Here's the flow chart. So he has 2 outcomes. One is G20 deal, one is no G20 deal, and one is positive dove, one is negative dove. So you get 4 combos with that. On the left, if we get a G20 deal of whatever type of deal we think might potentially be, even if it's just to put it back on the table, we're going to work this out sort of mentality going beyond. And the dovish Fed comes out in the next month or two, then he's looking at SPY trading to 300. Now, if there is a G20 deal, but the Fed is hawkish, he thinks we can go to SPY 300 and then top out and crash. On the other one, he believes we could break above 300 SPY. So that would be a big move up. On the other hand, if there's no G20 deal and we have a dovish Fed, he's looking at SPY 265, long gold and volatility. And if there's a no G20 deal and a dovish Fed, then he is predicting a 275 SPY, short the dollar, and long emerging market bonds. So a lot of analysis on all those, very interesting. My bet is dovish Fed, no G20 deal. So we'll see how that plays out. If so, we're situated perfectly for that. But we don't lose if the market goes up. So that's what's really important. This quote, "The U.S. tech war is a long-run clash for global hegemony in tech and military supremacy and is unlikely to be resolved soon. G20 may or may not result in escalation of tariffs, but Huawei indicates there may be no tech peace in our time." Here's an article from Bloomberg. "The U.S.-China trade war could trigger competitive currency devaluation across the globe and disrupt financial order," China's former central bank governor Zhao Huachan said on Friday. I never thought about that, but if the Chinese start to devalue, then that causes all the surrounding countries to match. Will that have some sort of ripple effect to the tune of strengthening the dollar? That's definitely something to ponder here. That's sort of what we saw last year, and a lot of pain in emerging markets. U.S. Atlanta Fed GDP for this quarter two is now at 2.1. Interesting chart someone put up trying to compare 2007 to the current. Of course, I think the market reacts to fundamental news, and that's what really makes the big swings. Not just magical technical analysis and wavelengths. This is Morgan Stanley's Business Confidence Index crashing the most since 2008. Had a similar scare towards the end of 2015, which had some nice volatility in the stock market. Morgan Stanley's Business Conditions Index, which captures turning points in the economy, fell by 32 points in June to a level of 13 from a level of 45 in May. This drop is the largest one-month decline on record and the lowest level since December 2008 during the financial crisis, according to the firm. We continue to get more indications that U.S. economic conditions are going to deteriorate rapidly during the second half of this year. Chinese Ministry of Commerce spokesman Gao Deng told the Beijing press conference on Thursday that there will be no winner in the trade war, which could cause a recession in the United States and global economies. The ministry did not disclose U.S. investment growth in China for the month of May alone, but the plunge seems to have coincided with the collapse of trade talks between Beijing and Washington. U.S. mutual fund and ETF investors bought $7.23 billion of stock this past week, which is pathetic compared to what corporations are buying back. That was the largest inflow to stock since March 13th and up from a $8.56 billion outflow a week earlier. So we've been seeing this huge flood into bonds and all that money coming out of stocks in terms of what real people are putting their money in. What about the surge in gold? Whether aided and abetted by recent bullish commentary from Stanley Druckenmiller, Paul Tudor Jones, or Jeffrey Gundlach, the ongoing gold breakout is the ultimate short USD expression into mounting dollar pessimism across macro, as there is no central bank on the other side who can pivot more dovish to offset the Fed's coming easing cycle, according to the Nomura strategist. But get a strong Fed or a hawkish Fed in all of these trades in the long bond, and the long gold position are going to get really wiped out. So for our portfolios, we'll just be playing this with tiny, tiny options. And so I do like trying to get a big win for the whale members with a tiny call option right now on TLT. Now we already have a put option, so I think TLT has a good chance of snapping in either direction depending on a surprise either from the Fed being too hawkish, which could even just become from them not lowering rates, or from tariffs being risen, then the Fed starts aggressively dropping rates and everybody floods into treasuries as a safe haven. Global negative yielding debt, $11 trillion. It's just completely crazy. And the market has reduced its hedge quickly. We've been noting this in our daily updates that the option market and the put option writing had dried up very quickly over the last few weeks as the market has become less worried about trade tensions. It seems like the market, there's just so much money leveraged into it, and so many people who do not want to sell because they know it would create an avalanche of losses for themselves, that they instead try to do the opposite. They try to push the tide to slowly push it higher. And anyways, they wait till the news comes out. And so I'd suspect if Trump were to say, hey, we're going to raise tariffs on the other $300 billion, it'll just reevaluate the price very quickly, a few percent down, and then sit there and wait again until there's more bad news. And that's just how strong this market has become because of the low credit out there and all the money slooshing around. Global government bond yields, ex-US at all-time lows, signaling no growth ahead. And last but not least, just an interesting picture. I haven't even read the article, just comparing Buffett's return against the S&P 500. And most recently, he's exactly the same as the S&P. It's funny that his portfolio is very similar composure as the S&P. And that's a wrap for today's update. 505-322-7515. Tomorrow, if you're on a free trial, you'll get a copy of our webinar recording from our Thursday class. And Sunday, we'll have a very detailed track record analysis where I'll go through the track records, show you how to read it, show you how these option trades work in a little more detail, a little more analysis, and kind of teach you some of the outcomes and methods behind how we put together these different trading strategies. So call Dean, save $1,100 a year while you still can before we raise the price. 505-322-7515.